Good morning and welcome to today's webinar, Solving for Finance, Insights from the Green Fuels Accelerator. I'm Shahana McKenzie, the CEO of Bioenergy Australia. Bioenergy Australia is the industry body dedicated to driving Australia's future bioeconomy. We work through our alliances, the Low Carbon Fuels Alliance of Australia and New Zealand and the Renewable Gas Alliance, to accelerate the deployment of low carbon fuels in Australia. Before we begin, I would like to acknowledge the Ngunnawal people, the Ngunnawal and Ngambri people, the traditional custodians of the land on which I'm speaking from today, and acknowledge the traditional owners of the various lands on which our attendees are coming from. I pay my respects to elders past, present, and emerging. A few housekeeping items to get us started. Make sure you introduce yourself and where you're coming from in the chat so that we can see where everyone's from. And please use the Q&A box for any questions for our speakers. The chat won't be used for any of the questions, so make sure you pop any questions in the Q&A. And we will be doing some live polling, so make sure you keep an eye out for that. As with all of our other sessions, I think we're up to this is our 7th webinar in the series. It will be recorded and available on our YouTube channel along with all of our previous webinars. So today's webinar tackles the issue of funding development and construction capital for low carbon liquid fuel projects. Australia has a promising pipeline of low carbon liquid fuels in various stages of development, which have associated investment of over 19 billion. Despite promising pipeline, no new projects have reached financial close in low carbon liquid fuels recently. This webinar will share research from the Green Fuels Accelerator on best practices for gaining access to finance through development and construction, and hear directly from investors and experts. Throughout today's session, we have a few live polls that will pop up on your screen. When you see a poll appear, just take a few seconds to select your response, and that will really help us to get a sense of the room, shape the conversation as we go, and inform as we move forward. The webinar will conclude with an audience Q&A at the conclusion. So as I said, make sure you pop that into the Q&A box. To kick things off, we are joined by Dr. Fraser Thompson, co-founder and managing partner of Cyan Ventures and the domestic chair of the Low Carbon Fuels Alliance of Australia and New Zealand. Fraser leads the Green Accelerator program, supporting the growth of Australia's emerging low carbon fuel sector. Today, he will take us through webinar agenda item, giving us an overview of the Green Fuels Accelerator before sharing findings from the Green Fuels Accelerator offtake handbook and introducing our other speakers. Apologies if you just heard my puppy dog. Welcome, Fraser.
Thank you, Shahana, and thank you to the Bioenergy Australia team for hosting us here today. Georgie and the rest of the team, we really are very appreciative. So we've got an action-packed agenda today. We are going to be sharing, myself and my colleague Sam Wallace, some of the insights from the Green Fuels Accelerator handbook. This handbook will be actually a public good that will be shared at the end of our Green Fuels Accelerator program. So we'll keep you tuned on the timing on that, and that'll be like an arena knowledge sharing document. We'll then have Robert Boyd. We're really pleased to have Robert joining us from Finvest Hub in International Civil Aviation Organisation, all the way from Canada. But as you'll see from his accent, he's actually from originally much closer to home, and he's going to give us this sort of international perspectives of what's happening on the financing front. And then we have a panel discussion, which is terrific. And I won't go through all the speakers there. Joy will be, from our team, will be moderating that discussion and introducing them later. But we really have quite a wonderful blend of people with different perspectives on that financing landscape, from all the way from debt to equity to early stage capital, as well as foreign investment. And then we'll do a sort of a quick wrap up at the end. So firstly, let me talk about the Green Fuels Accelerator, and I'll keep this very short because many of you have heard it before, but this is a program where organised by Cyan Ventures together with our partners, Boeing, Qantas, Mission Possible Partnership, Climate Tech Partners and others, and with generous support from ARENA, which we're very thankful for. And it's an 8-month pilot where we're taking 7 promising low carbon liquid fuel projects in Australia, and really trying to give them targeted support with a range of experts from everything from legal to financing to offtake to help accelerate their commercialisation. And this is a reflection that these first of a kind sectors are extremely challenging for even the best project teams to get to financial close. And so this program is only 8 months. We've only, unfortunately, because of the limits, we only got these 7 projects. We've had a ton of projects that reached out to us and saying, can we be part of this? And unfortunately, we don't have room at the moment. But this webinar was a kind of a way that we could share some of the learnings from the program as we go to try to benefit that broader ecosystem of projects, investors, and others that are really passionate about this area. And many of these issues that we'll talk about are not unique to low carbon liquid fuels. So I see we have some participants from other sectors as well, where I'm sure this will be particularly relevant. So with that, I'll hand over to my colleague Sam, and Sam is going to take us through some of the high-level findings from the Green Fuels Accelerator handbook on financing. Sam.
Thanks, Fraser. And thank you everyone for joining this webinar. So it's just worth saying right at the outset that in our conversations with the experts that we have involved in the Green Fuels Accelerator, so that's off-takers, financiers, and the projects themselves, as well as various other experts, we found that financing was a really critical barrier for projects reaching financial close. We have heaps of amazing technology in this country, but actually getting to construction and actually getting the funding needed has been the critical barrier. And so in the surveys we've done, the percent of projects rating the financing barrier as very high is 100%. So we can see that everyone is aware that this is an acute issue to getting low carbon liquid fuels projects built in Australia. And so what we have learned as we have conducted the Green Fuels Accelerator is that there are sort of 5 key things that it's really important for all technology startups, projects, and developers to know in terms of what it takes to get financing and get projects built. So the first thing is that obviously investors specialize in different kinds of projects at different stages, but it's not always obvious what those stages and what those specializations are. They change over time. They can't always be seen from public resources. So keeping lines of communication with investors open and understanding what exactly what stage they specialize in is really critical to make sure that time is well spent. The second thing is that the missing middle, development expenses, pre-feed and feed, is a critical gap. Check sizes start getting bigger, but the lending is still unsecured, and we find it really, really difficult for projects to get this funding before financial close. The third is that investor expectations vary across the different stages. They want to see different things, they care about different things. So once you've identified the right investor, taking the time to be really crystal clear on their expectations, again, often easier said than done, is really important before pitching. The fourth thing is that as we have spoken to lots of different investors, including project finance, VCs, infrastructure equity, and the government special investment vehicles, we've identified that there are sort of 3 core gaps that recur across projects to getting to securing financing. And we've developed a framework in the Green Fuels Accelerator for addressing those 3 gaps, and there'll be more on that later. And then finally, at financial close, all risks must be managed. The project must be absolutely watertight in order to secure funding. And we notice that there is a gap here between equity and debt. Equity can price residual risks, but debt will often not. If there are material risks left unexposed at financial close, lenders will often walk away. So the first thing is on how different capital fits different stages. So whether you are a tech company licensing your product or a technology topco doing a first project or just a project development specialist, there are sort of three main capital stages and three clusters that go along with it. So stage one is early stage, lab to demo for tech startups, concept and feasibility for projects. And these mostly are funded by venture capital, grants from universities, grants from government, or direct equity from the project sponsors. The second stage, development expenses, is for a first commercial scale plant, this is the trickiest stage. The checks are too large for VCs typically, and too risky for infrastructure and debt. So I'll talk more about this missing middle of where this funding does emerge, but it's typically comes from those with a strategic stake in the project, and it is the hardest to secure. Now, stage three is from financial close on commercial projects onwards, comes more from traditional sources, and this is where lenders typically start getting involved, project finance, infrastructure equity. Now, in the investment instruments also shift with the stages, not just the ticket size. And something that's worth noting is that for lenders in particular, the diligence process they have to go through is the same whether they're lending $50 million or $500 million, which means that they are harder to involve when check sizes are smaller because there is a sort of fixed cost on diligencing on their end. So lenders typically get involved in the later stages when the check sizes are much larger. Now, the takeaway here is that there's a large universe of investor categories and instruments, and they're all looking for slightly different things. And it can be very hard to tell what exactly they're looking for. Websites don't always say everything, things change over time. So keeping lines of communication open with all investors is always a good idea. Um, so the next thing that developers should know and is really important to talk about is the missing middle. So both globally and in Australia, there's this sort of, to use strong language, a valley of death between really excellent technology and commercial scale deployment. And the problem is that capital needs grow far faster than check sizes. Development expenses might only be 3 to 5% of overall cost, but that's still substantial. $1 billion project, might need tens of millions in development expenses, and that lending is unsecured. And the ones who are writing truly large checks, infrastructure equity, project financiers, typically aren't interested until a technology is fully de-risked and demonstrated at commercial scale. So there's a sort of structural trap here that can be really hard for projects to get through. It's not particular to low carbon liquid fuels. It's not particular to Australia, but because of the size of the Australian market, it is especially acute here. So for tech players, this gap starts to bite sort of around demonstration and into commercial scale deployment. And for projects, it's sort of after concept, but before financial close. So globally, we see more and more specialist public and private investors addressed to this missing middle. And we will hear from Rob on the role Finvest has played in securing funding in this stage. But in Australia, the problem remains really acute. So ARENA's mandate technically does cover this stage, but ARENA typically requires matched funding. So it can be quite difficult to secure DevEx funding in Australia. And while this problem remains, we find that the low carbon liquid fuels projects that have secured development expenses are largely from strategic sponsors and corporate off-takers using their balance sheets. So players with skin in the game in getting these projects to close. So just got a audience question here on how projects have found securing development capital and how hard it is.
I should mention all these questions obviously are confidential, that we just see the aggregate responses. So don't worry about if there was any sensitivity here.
Yeah. So very hard, if not exactly impossible, is definitely, as we can see, the consensus, and it is what we have found in our conversations with people involved in this space as well. So the third key point to make is that investor expectations vary across the 7 types of capital raise. So generalizing a bit, early stage investors want to take risk and expose themselves to upside. Later stage investors want to avoid risk and minimize exposure to downside. So the process of moving from pilot through demo to commercial financial close is a process of identifying and reducing uncertainty and allocating and mitigating residual risks. So forecast IRR often falls throughout this process, but that's a sign of a project maturing as risks are allocated and priced and is not like a problem. Also, as a result, documentation demands grow throughout the process as later stage lenders want to see more and more, I's dotted and T's crossed, and it becomes increasingly likely that projects need external support on their documentation to ensure it's investor ready. Another thing to call out is the closer one gets to financial close, the more investor expectations focus on demand. So, de-risking a project requires contracted cash flows from credit-worthy off-takers. Broadly speaking, no offtake means no financing. This goes for technology plays as well. Even those that purely have a licensing model, there needs to be a proven licensee in order for funding to be secured closer to close. So finance readiness, we have learned in the GFA that finance readiness has 3 core components. And so I'll pass to Fraser to really talk these through.
Yeah, so we developed this finance readiness assessment as part of the Green Fuels Accelerator. The FRA or FRA, so we open source competition if you can come up with a sexier acronym than we've got there. But essentially the reason we did this is that speaking to investors, we started to get an understanding of what they were looking for in projects. And there were really these kind of, if you like, 3 legs to the stool. The first was on development progress. So, has the project done the level of work you would expect at that stage? And often we find is that projects may say they're at a pre-feed, but the work packages from offtake to technology, etc., may be at very different levels. The second is around the FID readiness. So, looking ahead, are there debt and equity investors, given the nature of this project, that are likely to fund this? So what are the key, what's the match against some of these investor expectations? And then the third one is the transaction readiness. So you may have great development progress, you may have something that's potentially attractive to debt and equity investors, but do you have the actual quality of materials to engage? So do you have an investor-ready financial model? Do you have an IM that speaks to investors rather than arena or kind of grant-making bodies? So this is the tool that we've been applying to a range of different projects beyond just the accelerator as well. And on the next page, I just want to share some high level, some of the learnings from that. They're hopefully useful. On development progress, we do see this uneven progress. So there can be sometimes up to an 18-month lag between different components of the project. So technology may be advanced, but the op may be lagging well behind. And some cases there's justification for that. But it does become a potential concern from an investor standpoint. There's also, we see sometimes underestimating some of the time horizons going forward. So, very ambitious expectations of what it takes to go from an LOI to a detailed term sheet. And we heard last week in the offtake webinar from Natalie just some of the challenges there. From the FID readiness, some of the things we've heard is, concerns that the feedstock isn't actually secured. So if you look at things like scenarios like drought, competing demand sources, say from feedstocks, from cattle, and it may be a low priority for the supplier. So really how locked in that is. Offtake is a bit of an afterthought. So I won't go into detail on this one because we talked about it last week, but they're really thinking through things like the pricing mechanism, what the byproducts are, and their values, and the feasibility of actually getting that product slate actually signed up. The scaling technology underestimated, what it takes to go from a pilot demonstration to commercial. And if you're scaling it more than 100x the previous design, that's a real challenge that investors will have to get their heads around. Sometimes a little bit of technology tunnel vision. We can see that, everyone falls in love with their own technology, but actually being able to stand back and say objectively why this particular technology is likely to outcompete. Ignoring the remoteness premium. So a lot of developments in Australia in quite remote areas. And often we see that leads to slightly underestimation in supply chain costs. And then transaction readiness is, some of the financial models are a bit untested, and putting in the real kind of scenarios that investors would look at. Investor materials speaking to the wrong audience, as I mentioned, speaking to more like a government audience and an investment audience, and sometimes speaking to the wrong people. So the investor fit isn't, as Sam alluded to, has to be there from the start. So these are challenges. That's I must to say all the projects that we have seen in this space, not just low carbon liquid fuels, but first of a kind. Terrific bunch of entrepreneurs, founder teams doing great stuff. These were some of the sort of the common barriers that we see, that we think that projects should be mindful to. And so the next question, we just wanted to get another sort of confidential survey. I mentioned 10 issues there. And if you could just pick 3 that you think are particularly relevant for low carbon liquid fuel projects. And we'll do this one pretty quickly, Sam, I think, because just mindful of time too.
Yep.
We should have some elevator music playing while we're waiting. Thanks very much, everyone. And results. So interesting, pretty even spread. Interesting, I won't go through them all, but feedstock really stands out. The scaling technology question, the offtake is an afterthought. Very good. And on each of these in the handbook, we'll talk about some of the tips and tricks that we've seen around some of these issues to try to tackle some of those challenges. So that will come out in the full handbook. Over to you, Sam.
Thanks, Fraser. So we see that there are 6 dimensions for assessing a project risk to be ready for financial close. And those are offtake, financing, regulatory and certification, supply chain and ops, feedstock, and technology. Now, these 6 lenses are critical, and addressing risks on these 6 lenses are critical for financial close, but these 6 lenses are actually applied at every stage. A investor, even if you're looking at feasibility, an investor is going to want to know what your offtake strategy is. They're going to want to know how you're thinking about feedstock. But expectations, as discussed, increase at every level here. And by financial close, every material risk across these categories must be dealt with impeccable documentation, quantifying and allocating risk. Where possible, risks should be allocated onto counterparties. So tech risk should be moved to the tech provider using warranties, supply risk to the feedstock supplier through contracts. But it's worth saying that risk mitigation is not free. CapEx contingency, insurance, counterparty guarantees all add costs and all affect project economics. So there's a sort of tightrope act of managing both the economic impact of risk mitigation and the need to mitigate risk to attract financiers. It's also worth saying that risk can't be entirely eliminated in this way. So full wrap EPC contracts for construction are pretty rare, So projects these days accept the residual, which is then priced by investors and factored into weighted average cost of capital. The other thing worth saying is that debt investors are tricky. For them, many risks are unpriceable. So they won't see unmitigated, if there is a major unmitigated risk on any of these six factors, debt investors won't charge a higher rate, they'll just walk away. But these are if all material risks are addressed and allocated across all these six, that's what it takes, and there's clear documentation backing it up. That's what it takes for a project to be ready for financial close.
Terrific. Sam, what we might do is just skip the final poll question in the interest of time, because I want to move on, because we've got a great set of speakers and a panel discussion. So that thank you, Sam, for taking us through those findings. I'd like to now hand over to Rob Boyd. Rob will be familiar to many of you. He's worn many past hats in Australia, and a good friend to many of us here. What he's doing at the moment is really interesting. So Rob is serving as the chief of the Finvest Hub, which is part of the International Civil Aviation Organisation. And they are seeing these same issues that we're seeing at the Australian lens, but on an international lens. And so we were really keen to get Rob here to share that perspective and how they're tackling this at that international level. So over to you, Rob.
Yeah, fantastic. Thank you very much, Fraser, and good morning. I think it's probably good morning to pretty much everyone. And thanks, quick thanks, of course, to Bioenergy Australia for the opportunity and for hosting this. So, as you've said, as both you and Sam have really nicely illustrated here, the approach, the problems that exist and the approach to how you go about sort of methodically trying to solve for them, although we're doing it on the opposite sides of the world, are very, very similar. So I think that's probably a good thing. If it was completely divergent, that might be a worry. I'll talk through a few of those things in a bit more detail. I wanted to just give a little bit of background quickly to, it might be a refresh for some, and it might be new for others if you're newer in your project development. But around the time, so 13 odd years ago is when this chart starts. That's around the time that I would say Australia's first wave of activity on low carbon liquid fuels was actually plateauing a little bit. There'd been great momentum for about 4 or 5 years, and it just started to taper off a bit. But at that point, internationally, things started to really kick off. So in 2013, you had a global agreement to establish a market-based mechanism to limit the growth in aviation emissions. That isn't so common to get all countries, 193, to actually agree on something like that. IMO's still struggling to get the international agreement there. Why that's important? So 2016, the word CORSIA came about, or the acronym. And I think many of you have heard that. But the R and S in CORSIA is reduction scheme, and that essentially relates to SAF. So it was over that 3-year period that member states required that sustainable aviation fuel would be part of the CORSIA agreement. And what that then did is it launched a global momentum through ICAO, through the UN body, to establish really important global standards for what do we consider a fit for purpose fuel, what's safe to put in aircraft, but also really importantly, what's the definition of global sustainability. And so that was actually agreed in 2018, and that again is not so easy to get at the global level. 2019, 2020, we had CORSIA, of course. We had, COVID, which sort of changed the dynamics a little bit of CORSIA. But interestingly, in that backdrop of an incredibly difficult global aviation environment, both the commercial airlines and the governments, within 12 months of each other, agreed on the common goal of net zero 2050. So the governments did it 1 year after the commercial sector, but that was in 2022. And that links a little bit to what I've got now below. So that wasn't just done in isolation, saying, yeah, that sounds like a nice idea, let's just go for net zero. There was reams of modeling that sat behind that, including what would be the financial expectation to actually achieve net zero. And that's where the mid-case forecast sits at about 3.2 trillion in clean energy financing that's necessary to actually scale up to the degree. And that you can see in a couple of those boxes at the bottom, that's actually baked into formal assembly resolutions to pursue mechanisms to activate globally clean energy financing. And that's really what underpins why Finvest exists. It's a dedicated initiative and then also platform within the UN aviation structure to activate clean energy financing to accelerate this scale up. And I threw in 2028 just to, I think it's really important when we're doing these things and projects, they will operate for 20 years. So looking a little bit into the future from a policy perspective, I think is very wise. And that CAAF, it's a Conference on Aviation Alternative Fuel number 4. So that's required to occur by 2028. And that's where some of these quantitative discussions on global agreements for quantitative goals have been set. Last was set in 2023 at a 5% CI reduction. And 2028, no doubt there'll be similar discussions. So if I was watching for what's coming, that's one meeting that you want to keep an eye on. The great thing with all of these, every working paper and information paper submitted from countries and observers is public. You can get it off the internet. So if we keep moving on, Sam. The next slide is what jumps out at you is the green bubble. There's a heck of a lot of announcements that we've collected as ICAO over the past decade. So there's even more now. I think there's something like 700. On the left, and this is not an exclusive list, but there has been 20 years of enabling support and activation, whether it's been all the bundles of different flight activity that occurred in the early 2000s to all the technical pathways, achieving a technical certification through ASTM can be anywhere up to 5 years. Some of them took, if we go way back. So that body of work is so valuable to build on. Having agreed sustainability criteria and not trying to sort of second guess what every country might interpret as sustainable is extremely valuable. We've got the net zero commitment. And I'll talk a little bit about these country level studies. We've got fuel being produced as well. That's the 18 ACT SAF studies. But really the message on this slide is we have a very small number of global facilities that can produce SAF today. Yet we've got a huge cluster of collected announcements. So the reality is, as Sam and Fraser have really put it nicely already, most of these have got lost in the valley of death. So we need to change that conversion rate at the global level to what's less than 5% really needs to be getting up to 20, 30, 40%. So that's one of the goals of Finvest. And one of the sometimes, show this, is a lack of capital. My view is no, it's not a lack of capital in the system. There's a vast amount of global capital and a great willingness to get engaged in this topic and sector. But as it's already been put, it is the risk profile of these projects that's clogging up the allocation of that capital. So that's actually the bit we're working on trying to improve, as well as how do you help these companies get through that valley of death, which is not friends and family money to go through that phase. As it's been shown, it's 10, 20 to $50 million. So if we go to the next. Again, this is very similar to what you've just seen, but this is how we think about it from a Finvest perspective. So you've got your early stage projects. Now I put what we call ACT SAF. So ACT is an acronym for Assistance, Capacity Building and Training. And when we think at the global level, okay, there's countries well developed like Australia or the US or Canada or the United Kingdom or Europe and others. However, there are realistically probably more than 100 countries that have great feedstock potential around the world, but are not necessarily in a position to sort of organize that, understand it, and put it together with the technology options that exist and turn that into a project. So that's what we do in the ACT SAF stage. And you can click through a couple of clicks on this, Sam. So I don't see a problem. I have a tick where it says, is early stage a problem? I don't think so. Universities and academia also doing a really stellar job in that regard, and it's very important to continue to fund. And on the other side, also, I don't see a big problem with if you can get a project to FID readiness, it is absolutely possible to unlock a lot of options to take serious look at these, and in many cases to unlock those quite large lines of debt and even concessional debt. However, you've got this pre-feed feed stage, which is incredibly difficult. It's where more than 85% of the global projects sit in this stage, and there is significant amount of money required and time to go through pre-feed and feed. I think sometimes it can be assumed that it's just quick. It's only a 2-month job to go from pre-feed to feed. It's at least 2 years typically, and that requires cash burn. One of the numbers I've put, if we just go back to that one, it's worth just having a little think about. That's 6 billion per annum. That's a big number. Globally, it's not that big though. And where I get that number, if we work backwards from that 3.2 trillion that we accept is necessary over the next 24 years, we're in 2026. And roughly, you can look at ICAO has sort of rule of thumb, what we call rule of thumb estimates by technology and feedstock and so on, and they vary. But let's just pick a bit over $1 billion. Use round numbers here. It brings us back to about 120 facilities a year globally, at a bit over $1 billion a facility. And then if we apply a failure factor, a failure rate of about 50%. So we need to double then the amount of pre-feed and feed money we're throwing in. 50% is probably a good result, but let's just accept that. That actually equates then to around about 6 billion a year needed in that pre-feed and feed stage at the global level. And again, while that at surface level seems like a large number, if you break that down to a country that might perhaps have 1% of global jet fuel uplift, that would be 60 million a year in catalytic funding through that. It's very achievable. And actually, many countries are providing support roughly in line with that. And it's a strong advocacy message I'm pushing with different governments to recognize that that is the point they want to be focusing on, not getting sort of extremely concerned about the very large trillion-dollar numbers. It's actually this set area where the governments need to have their attention. Australia, I think, is doing a good job in this regard, certainly at the moment. So next, please. So this is the Finvest system, right? It's a system. So we'll go through the ACT-SAF process and then come into the Finvest hub. Alternatively, and that's often government-led if it's coming through that channel, but alternatively, projects can be independently developed and join Finvest, and we will start essentially our vetting process, our capacity building initiatives, and the goal is to get them out of Finvest, so get them to FID and move them on. So let's go to the next. So I'm just conscious of making sure we stay right on time. This is what Finvest is conceptually. Again, not particularly drastically different to the Green Fuel Accelerator here, but ICAO sits in the middle. One thing ICAO can bring here in a very strong way is the sort of the words of trust, respect, authority, standards as the global regulatory body, or the one that sets the regulations. It does have the whole of world buy-in there, and it is excellent at attracting both projects, but also attracting all the financing options, including the concessional financing options like the multilateral development banks and other initiatives like Green Climate Fund and World Bank and so on that are targeting how to activate this. And then around the outside of the initiatives that we are pursuing to essentially tackle the risk problem. So at a global level, there's still more work needed on what I would call innovative financial instruments, and that includes work necessary on improving the offtake, the ease of offtakes. Often projects will just look at single airline offtakes. This is extremely complex. It's complex for the airlines as well. So there needs to be a better de-risking mechanism for the airlines to have multiple long-term offtakes, which are very different to their normal fuel procurement patterns. A lot of capacity building. Our partner group I've got some of them listed at the bottom, but growing quite quickly, where we're bringing expertise in to deliver some of this bespoke capacity building to different projects. And obviously, the outreach and advocacy is particularly opportunistic when you can activate directly into governments that might not as yet be seeing the opportunity for them as a member state, for them as a country, to have a project developed in their country, that delivers economic benefits back to the country. So particularly Africa, parts of Southeast Asia, Latin America, that's a really important bit. And of course, what I would really push for is you've got to turn the policy on to make that happen, because that's the magic ingredient that the governments have the control over. We go to the next. So this is just some of the things that we do on the capacity building side. So this training and guidance and so on. That's an accelerator program that we're developing. In fact, with Airbus particularly at the global level there, which is great. But that'll be expanded. But the one I'll touch on here is the bankability checklist, and it's got a lot of similarities to what was just shown. So more detail on the Finvest website to take a look at there. But let's just go to the bankability checklist on the next slide. This is the final one. And I know there's I think 6 criteria sort of shown before, but these are the 10 that we use. And underneath these sits 2 or 3 or 4 subcategories that projects are all sort of assessed on. We go right through from project narrative, the technology, very important, the risk of actually how do you go about the construction, delivery, what's the team look like, feedstock, permitting, what's the structure, the capital structure often needs some help, revenue, counterparties, and then policy. But the 2 I would say that stand out the most as usually being underdeveloped, even at the FID or as they're approaching the FID stage, is contracted revenue and feedstock security. They are weighted the highest. So the model that has been sort of developed in the Finvest world has been developed in conjunction with about 40 global financial institutions. So really it's about helping projects think and look through the eyes of the bank as early as possible, because the banks won't turn a blind eye to something that they're not comfortable with. So there needs to be enough opportunity there to bring the bank in to help. That's really what you want, even if there are still some gaps there. And the final bit, just on 10, is policy always remains, such an important part of how do you ensure that these projects get to that bankability stage. And that's another day webinar in itself, as you know. But that is the bankability framework. So I'll leave it at that. I know there's a really high caliber expert panel to follow with obviously it's going to be, I think, a great discussion, but I will step back or hand back to Fraser, and I hope that's been a useful, just sort of high level international context.
That was great. Thank you, Rob. And it's really good to get that perspective. And, there's so many numbers there that I thought was really fascinating, from the 85% of projects stuck in that middle to the funding requirements, and also your 10 checklist, which I think is very consistent with how we think about it as well. So thank you, Rob, for that. I'm going to hand over to my colleague Joy, who is principal at Cyan Ventures, and she has somewhat recently, joined us from Bain, where she spent 10 years as one of the leaders of their private equity practice. Over to you, Joy.
Hi, everyone. Thank you, Fraser. So today we're going to have a panel with, as we mentioned, a very high caliber set of individuals. We have Oliver Yates, who was the former Chief Executive Officer of the Clean Energy Finance Corporation. We have Rupert Maloney, who is the current Executive Director of Alternative Fuels at the CFC. We have Tim May, who is an Investment Director for Infrastructure at IFM Investors. We have Celine Paul from SAF Investments for Airbus. And Ross Cooper, who's the Director of Investment for the Investment Division at Europe, Middle East and Africa for Austrade. So please do send through your questions via the Q&A function, and I can try to make sure that those get through to the right people. So to kick us off, I thought we could start with you, Oliver. We've talked a little bit today about the missing middle, and we showed that slide where it sort of bites for across different stages, depending on the pathway. Perhaps you could share a little bit on your take on the missing middle, and from what you've seen in practice, and any ideas on how you think it can be overcome.
Thank you, Joy. Look, let me just jump in. Obviously, I'm now the former CEO of the Clean Energy Finance Corporation, and I guess as you get more and more former, you get to be more blunt. So I'll be actually particularly blunt today, if I could. Rob talks about this has been going on since 2013. It's actually been going on until 2005, and there is still absolutely no difference in relation to the reason that these projects are not closing. Right? They're not closing because and they disappear down this, quote, valley of death because of two reasons. And they are all, and reasons, completely within the government's control. One, lack of demand signals, and two, an unwillingness to take the first of a kind of development risks that the banks won't take. So you have projects that are scaling up in this sector, the banks won't take the scale up risk on first of a kind projects, and the government is not putting in place the demand signals. That's what your valley of death is. I mean, it seems to be quite sad that people seem to kind of like, if you're a developer out there, you'd think that you are the problem. You are not the problem. You've got your site permits. You've got everything else. Two, the things that you're missing, you need a bankable demand signal because you need the revenue certainty. And then if you're doing a first of a kind projects, there will be risks the banks will not take, you cannot take, equity cannot take. And then it becomes a government's responsibility that if they want these things built, they actually have to build them. So in this scenario, if you wanted a solution, I just, I haven't turned my camera on. Actually, I haven't turned my camera on. There you go. So now my camera's turned on, even better. So if the government was serious about addressing these two issues, then it needs to actually think about how it actually goes and deals with those issues. Okay, so it could provide a demand mechanism, and that's what we're hoping is going to come through. But let's assume that demand mechanism is still not enough and projects still can't get there. It is going to need to provide some development capital to enable those projects to continue waiting for the demand signal because they can't get there without a bankable demand signal. So they will have to start to provide very good projects with some strategic capital so they can hold on the runway until eventually the demand signal's there. Secondly, they have to be realistic. If those risks are not going to be taken or cannot be taken in a first of a kind project, a grant ain't going to fix it. A policy statement ain't going to fix it. The government is going to have to take those risks that the private sector can't take in relation to a first of a kind projects. So the government is kind of missing these two pools of risk capital, for want of a better word, that would enable projects to hang on longer until such time as they eventually condescend to put in the demand signals that we all need, or a risk capital arrangement which allows them to take the risk which they know the private sector won't take. So I'm going to just run on to a couple of things. So all I can be saying is for you guys, I give you a little bit of advice because someone's asking me what I'd be saying for projects right now. I'd be saying for projects right now, you need to start to be very, very, very clear with government of what is required for you to be able to build your project. You need to tell the government what are the things that you actually physically need, and you need to be very specific with them about the support that your project requires. You need to work together, and then if you can prove that you and all number of projects still face the same problem, and you're all going down and dying in the valley of death for the same reason, realize it's not your problem. It's not your project's problem. If there's a pile of you suffering from exactly the same death scenario, it's a structural problem. It's a systemic problem. And you need to go together to the government and make sure they need and understand the systemic problem. So I'm going to end there and just basically say quite clearly that if the government actually genuinely wants this industry and genuinely wants it to succeed, they are going to have to be honest about making sure the demand signals they put in place are large enough and are big enough to enable projects to be built. And if they're not, they have to be ready to provide development capital so projects can hang on until such time as they pluck up the courage to do it. And then they also need to have a pool of risk that they are willing to take on first-of-a-kind projects for risks that are unbankable, that no one can take if they want those projects built. So there you go. There's my way to start off a good discussion. Robert, over to you. Rupert, sorry.
And Rupert, maybe thinking about where you're at right now with boots on the ground, you're seeing these projects every day. We've talked a lot about the demand mechanism and how important that is, but perhaps you could build on what Ollie has spoken about and what you're seeing on the ground at the moment, and also maybe a few tools that CFC currently offers today to help projects get through to being operational.
Yeah, happy to. Always fun to follow Oliver. Certainly when I sit within the CEFC, and I don't have the same freedom, I suppose. But no, I agree with a lot of what Oliver was saying, and maybe I'll build on some of it. But so yeah, maybe the tools, maybe for those that we plan on this webinar who don't actually know who the CEFC are. So I'll very briefly, we're federal government's green bank. Largest green bank in the world, I believe now. What does that mean in practice? It means really that we're an investor, we're here to make a return. But while the private sector are should solely be focused on a risk-adjusted return, maximising their return, we're there to make a return, but we also have a very clear policy purpose. And our purpose is really around facilitating finance into the clean energy sector in Australia, and also facilitating Australia to achieve its greenhouse gas reduction targets. So that's a pretty broad sort of policy purpose, and we use a number of different tools to go at that purpose, and also achieve a risk-adjusted return at the same time. So we do try and do a number of those things that Oliver mentioned about being willing to go early and take some of the risks that maybe the private sector or certainly the banks on the debt side are inherently conservative, as they should be, and that's how they're set up, and lean in and understand those risks and be prepared to really finance or invest in those first-of-a-kind projects, prove up those risks, talk about those risks, educate the market, and ideally have the market follow us, or come with us, ideally, or follow us very closely behind. We also have a lower cost of capital, what we call concessionality. So we do have the ability to pass on that benefit to projects on a risk-adjusted return basis again, but and provide that support to the projects where it's needed, and filling those gaps. And we've got experience doing this, and it goes back to the early days when Oliver was at the CEFC, but we continue to do this. When we think about it as the clean energy sector continues to evolve, and certainly this is one of the frontiers today, the low carbon fuels market. But back in the early days in the renewables, we were financing the first large-scale renewable projects in Australia when they were sort of unbankable at the time because they'd never been done in Australia, and then very, very happy to pass the mantle to the banks and the private sector to continue to do that. Obviously, a very bankable sector today. We've done that we're doing that in grid, we've done that across hard areas like waste to energy, where we're certainly looking to do that in low carbon liquid fuels, and we believe that low carbon liquid fuels really, as Oliver just articulated, really needs a government investor like the CEFC to come in there, provide a cornerstone position, ideally facilitate and crowd in the private sector, because we can't do it all alone, and I don't think it is good for us to do it alone. We want the private sector to come in with us and get those first of a kind projects up. And maybe I'll just quickly touch on sort of what we're seeing in the market, and some of the challenges for projects. Certainly, all these webinars, you'll demand, but maybe I just take that to the next level. So that pathway to demand, because ultimately this will always be a policy-driven market. I don't think we can sort of kid ourselves otherwise, that where fossil fuels is priced, that we need policy overlay to enable these markets, and we need demand pull through. But we look and we hope that it happens sooner rather than later, that we're going to have those very clear demand signals in the market. But when we invest, whether it's a debt or equity, to again minimise that risk, we really want to be backing the projects that are are going to be most successful when these markets are developed. And what does that mean? It means the projects that are most competitive, because ultimately when we talk to the off-takers, as the projects do, the off-taker is a commercial off-taker, and they'll be wanting to buy the lowest cost product on a carbon abatement basis, and they have options to import in that product into Australia under the current sort of regime. So the projects need to be competitive and really evolve through that sort of cost curve. Obviously, there's limitations on feedstock, and the cost curve will evolve over time. But the most competitive projects, that minimises the risk. Because you always look at it certainly from a debt perspective, is that short offtake, demand signal, but you always look at the downside. What happens if offtake falls away? Are you the project competitive in the market? And we have to remember technology will evolve here, and hopefully technology evolves in a way that price goes down over time. So again, the CapEx build is locking in a technology and a price point. So again, you need to be competitive. So that's a key focus. Another key focus that we're sort of seeing in the market is capability and experience. So sponsor or the development entity's capability and experience. This is pretty complex stuff. This is a lot more complex than the renewables industry was or is. We're talking about very complex chemical plants here, hazardous materials. And so does the developer have the capability not only to develop this project, to construct the project on time and on budget, but also operate the project? Do they have the right capability there? Because we've certainly had many learnings over the years that without that right capability, like it's obviously a very entrepreneurial space, but bring that capability there. And then tech risk, which relates to that as well. There's different evolutions of tech risk that are being developed or being rolled out through some of these low carbon liquid fuels projects today. And how does that get managed? Maybe I'll leave it there.
Thank you, Rupert. Maybe we should hear from the private sector. So Celine, who is with us from Airbus, perhaps you could share a little bit about your view on low carbon liquid fuels and why it's an interesting area for you and Airbus.
Yeah, thanks, Joy, and hi everyone. Look, at Airbus, we are committed to the decarbonisation of the sector, and SAF is a key lever to decarbonise the aviation industry. So we see our role as a catalyst to help with the development of SAF and to support our customers with that uptake. So one of the initiatives we've started doing over the last few years is investment in SAF projects. And Rob, as well as Sam, have talked a lot about this valley of death, and this is a gap that we had identified, and we started investing, especially at that sort of pre-feed feed level where the traditional sort of institutional investors and infrastructure investors find it too early and too risky for them to invest in. So in Australia, we've invested in a couple of projects. We've invested in Hammer Energy, we've invested in Jet Zero, and we've also invested in technology, in the technology de-risking space. We've invested in Climate Tech Partners, which is a venture capital firm that invests in technology companies.
Thank you, Celine. And when you're thinking about the sector, are there any particular areas in particular? So you mentioned you've covered quite a range. Looking ahead, are there any particular sectors or sub areas within the sector that are particularly interesting for Airbus?
Yeah, look, at the end of the day, we are technology agnostic. What we're looking for is the scale up of the industry and the development of the industry. So we are looking for projects that they may be a bit early now, still a bit risky for the infrastructure investors to invest in, but we want to see a pathway for them to become bankable in the future. So we want to see some of the building blocks that have been mentioned by other speakers today. We want to see some of these building blocks being developed, especially around the feedstock and the offtakes, etc. Can we see a pathway to them becoming bankable? So yeah, a lot of things have been mentioned already, but I would also echo, the capabilities is extremely important. The strong team is something we really look at, both on the technical side as well on the commercial side. As Rupert mentioned, they're a very complex project, and they're very big project. They may be requiring, only a few $1 million of sort of development capital to progress at this stage, but eventually they may become billions of dollars of investments. So they need to be able to demonstrate that they have the capability to address that, and to demonstrate that they have they're thinking about governance, they're thinking about disciplined capital allocation, they're thinking about risk registers and all these things that will make them bankable projects in the future.
And is there any other advice that you would pass on to the projects that are listening here today that would help them, navigate the financing challenge?
Yeah, look, I think one of the things that often in the stage focused on the development of their project and the technical aspects, and so to invest in the capital raising capabilities. And I think it's been mentioned by Sam and Rob as well on this, that ensuring that they can talk the language of the investors, that they understand the expectations that the financiers will have is very important. Also, trying to secure grant funding early is very helpful, because it does demonstrate that they've already gone through due diligence processes, that they are a credible team. It is important, and then wherever possible, show some tangible progress. Show that there's already some of these building blocks in place. That the feedstock conversations are well progressed. The offtake conversations have started. These sort of things are very important.
We've also heard about the importance of strategic involvement. So having a strategic partner early on is a very clear positive signal. Has that been your experience as well?
Yeah, and well, we want the strategic, I guess. So so for us, we look at the involvement of other strategics as well. So if other strategics have already been involved, again, that's usually a good sign. That means they've passed the test of around due diligence, governance, those sort of things. So it makes it easier for us to pick it up.
Thank you, Celine. Turning to Tim now, another member of our private sector investor community, Tim from IFM. Similar questions for you. What makes this sector, the low carbon liquid fuel sector, exciting for you and for IFM?
Hi, Joy. And just for everyone's background, I'm from IFM. We invest on behalf of millions of people through their retirement savings. And in my team, we particularly focus on infrastructure. So we're particularly focused on that long-term ownership horizon of critical infrastructure assets. And for us, and to your question, that includes significant Australian airport investments. And one of the challenges we've been asking, one of the questions we've been asking across our board tables is, what does it take to decarbonise the sector, not just from a scope 1, scope 2 perspective, but thinking more broadly as an industry, and acknowledging, Celine, and your important role at the aircraft manufacturing end of the supply chain. How can we continue to create pathways for us all to travel over the longer term, particularly in a sustainable way? So I think to that, there's really those 3 key buckets of interest for us in this sector. And I think it's really the unique fusion of these 3 key areas, which make low carbon liquid fuels investment particularly attractive. So I've touched on the first area, which is aviation is a pretty challenging pathway to decarbonise compared to what we're seeing in the light vehicle market at the moment. We see SAF as the most credible pathway to get us closer to those net zero targets. Second, And this is an interesting area that more of our super fund investors are asking for insights. They're asking for opportunities actually around longer term. Whilst we had a bit of a shift to globalization, probably over the first 20 years of the century, now investors are more asking around how can we make the nation more resilient and what type of investments can contribute to that. So I think we're all very aware that about 90% of liquid fuels coming into Australia are imported. So if there's ways we can make the nation more resilient when it comes time to crisis, that's a really attractive investment opportunity for our investors. And third, and I think Rupert touched on this quite strongly as well, we want to invest in areas of sustainable competitive advantage. What makes Australia better off? What's its right to produce fuels, noting that Australia has had its own challenges with manufacturing over the last 50 years. And stepping back, we see a tremendous competitive advantage in our feedstock sector. We're currently, as we all know, exporting a lot of these feedstocks. So for us, that confluence of a resilience opportunity, a decarbonisation opportunity, and leveraging and harnessing Australia's competitive advantages is where we see a particularly attractive investment moving forwards. It's probably just worth touching on, we do have a multi-year partnership now with GrainCorp and Ampol as two other long-term, quite well-known, iconic Australian brands. And together we're committed to working together with industry players to create long-term solutions which benefit all Australians.
Thank you, Tim. And perhaps you could share a little bit when you're evaluating a project, given now your experience with GrainCorp and I'm sure many other projects, what are you looking for? What stands out for you when you're looking at a project?
Yeah, thanks, Joy. And I think there's some synergies from what Celine was saying at that more strategic level versus us as a more risk-averse core infrastructure investor. I think it's fair to say we're attracted to technologies which are well proven on a global scale. We don't really like to be first movers from a technology perspective, but I do think it's really important that we acknowledge that the scale of the challenge, and once you start to deeper dive in terms of the feedstocks required and the different varieties of feedstocks required to create scale in this industry as Australia, we do recognise that multiple feedstocks will be needed. But for us, at this stage, we're more focused on the well-known, more established HEFA type technologies. A really important consideration that we're really focused on, really interested in, is this concept of global competitiveness. And how do we do that here from Australia? Noting we have some competitive advantages, but realistically over the long term, we're going to be competing with some pretty large global backed projects, often which are state funded with typically more generous subsidies. So I think the latest Bloomberg New Energy Finance report talked about 16 new projects in China in the first half of this year, 4 in the rest of the world, and obviously none in Australia. So I think for us, having that ability to create scale, drive cost competitiveness is really important. But there's still probably a little bit of a gap there. And that's where, to Oliver, some of your points, that does require a multi-industry approach in terms of risk allocation from off-takers, from government, from developers like ourselves, and even from the feedstock providers, to making sure that we are creating long-term value for our nation.
And then to bring that back to being practical for projects, would you say that it's just very important for them to articulate how they plan to be globally competitive?
100%. And if I'd sum up in 3 words, it's what is your right to win? So we have evaluated dozens of projects. There might be other parties, maybe Rupert talked to hundreds of projects, but I think for us, how can you quickly establish in a short period of time why a project is destined to win? And then just some more practical shortcut measures. I think as Celine mentioned, really credible if you are getting grant funding, that becomes a little bit of a screen for later stage investors. We'll be also looking to how you engage with your customers. It's not necessarily expecting you're going to have a long-term offtake, but I think for us and for other potential project developers, you want to really genuinely understand what your customers need. What are they looking for? What are their concerns? And once you have that, reformulating that into that credible investment plan, sort of stepping back, ultimately, bankable project, cash flows will be king. If we can't see that credible pathway for the revenue line, nothing else in the project is going to stack up.
Thank you, Tim. Interestingly, we interviewed David Stribley from Hammer on our podcast, and he emphasized that customer point as well very strongly, that having that customer view is so critical. Maybe now turning to Ross, and maybe it would be good to get the international view. Ross, what types of overseas companies are you seeing showing interest in Australia's low carbon liquid fuels industry? And we've just talked about the importance of being globally competitive, so it'd be interesting to understand how the rest of the world is viewing our industry.
Yeah, thanks, Joy, and thanks for having me, and good morning, everyone. So I do work at the Australian Government's Trade and Investment Commission. So if you're not familiar with us, we are the Australian Government representatives overseas. We have offices in about 60 to 70 locations around the world, and we're there to work with Australian businesses in trade and attract foreign direct investment into the country. So our engagement with the sector is probably a little bit broader than just thinking of it from a pure financing and investment perspective. We do talk to and stay in touch with banks and equity investors, but we work right across the supply chain. So our job is working with operating businesses that come into Australia. And really, our engagement's right across the board in this sector. We're engaging with, project developers, energy companies, trading houses. We've got interest on feedstocks, aggregators, airlines and fuel traders, contractors and the like. So it's really spread, and the insights that we get told are really representative across the industry. Probably the best representation we have of that is that we do work to events, and we worked with Bioenergy's Australian Renewable Fuels Summit in March, and we had 45 companies come into Australia at that time. The good thing is we're seeing lots of interest across the world. We work to 3 regions. We work to the Americas, we work to Asia, and we work to Europe and Middle East and Africa. And we had companies from all 3 regions coming into the country. Probably for this audience, maybe just a highlight on some of those companies is they enter the market in many different ways. There's no one size fits all, and some of them will be bringing their capital into projects. Sometimes they do that greenfield. Quite often they like to partner with other companies, domestic companies in Australia, joint ventures, or there is this sort of leveraging technology. So again, we would say when you're engaging internationally, keep in mind that there's not a one size fits all. There's all different ways of engaging. And importantly, it's also understanding what are some of the drivers of that engagement. Sometimes it is just a pure economic engagement. But other times it's also around the drivers from the countries in which they're engaging. And Australia's been a long-term supplier of energy, particularly into Asia. We've been a reliable supplier, politically stable, and a good long-term place for people to get their supplies. And in the current environment, that's becoming even more important because the landscape's definitely changing. So you give consideration when you engage internationally, what's driving this company, what are they trying to achieve, and what might be a different model in which to partner or engage for a project in Australia.
Thank you, Ross. And would you say there's anything in particular that stands out as of interest? I mean, we've talked about the feedstock opportunity and Australia's sort of broad benefits, but is there anything else for you that you're seeing over and over again come up in these conversations?
Yeah, look, I won't harp on it because I think it has been spoken to several times. But of course, the demand side measures do come up, and I work in our Europe team, and Europe already have some demand side measures in place, and so they are important that people knowing if they can do a project in Australia that there's going to be demand for the fuel in the country itself. But yes, lots of things come up in terms of competitiveness of those feedstocks in your process. So again, give consideration to how far do you need to transport your feedstocks to get to the site and the costs associated with that. And your permitings, what is the process to get to that? And we have seen, I guess, a lot of inflation in building construction materials at the moment. So yeah, those sorts of things do come into play, but they're not alone to Australia. I think just coming back to your question, uh, that commercial certainty is really important in the decision making. Just maybe going a little bit broader out, we know that HEFA has a limited pathway, and we know that, the commercial projects globally to date have been HEFA. And it would not be surprising to us that the first few projects in Australia are going to be HEFA. But I think if we look at the pipeline going out, the forward pipeline, particularly in Europe, it is really looking at those next generation feedstocks, those other technologies. And when we talk to banks, it really comes back to the points that both Tim and Oliver and Rupert have touched on. They are looking for, they wanting to see that the technology is proven, so they're comfortable with backing HEFA. And so to get that certainty, they need that certainty. So I would say if you have a novel feedstock or something that isn't as commercial as HEFA, that your friends are actually the development of those projects internationally as well. If they are getting up in the other technologies and getting backed, that will be a positive for your project in Australia as well, because the finances, the banks, and that will be looking very closely at the development of the industry more broadly. And we do know that with the mandates in Europe, they are really exploring very strongly other feedstock channels to develop the supplies that they're going to need to meet their mandates in the future. So that's a really important one, I think, for Australian developers to watch closely and look at who's doing those deals and participating.
And it sounds like perhaps articulate again in investor language what's happening globally and what's succeeding globally and how it relates to their project. Just quickly, Ross, are there any events that you're planning to participate in overseas that Australian projects could get involved with that we could promote for you on this panel?
Yeah, look, it's really just to touch on we've got those 70 offices around the world, and our team's really engaged on this topic. It's a priority for the Australian government, so we are leaning into it. So definitely we're attending events all offshore. In Asia, we will be at the Sustainable Aviation Futures China Congress in September, and our Singapore team will be at the SAF APAC Congress in November. I know our Europe team are visiting the Argus Biofuels event in October, and the World Biofuels Ethanol in Barcelona in November, and Australia will have quite a presence at COP31, working really closely with DQ there. And our Americas team are going to the Argus North American Biofuels, New York Climate Week and Sarah Week. So any of those events, if Australian proponents are heading offshore, please get in touch. We'll put you in touch with our officers offshore so that you can work in with any programs or roundtables or discussions they're having more broadly there. The last thing I'd say is the event that we really lean into in Australia is Australian Renewable Fuels Summit, and our team offshore will be bringing companies again in March 2027 in Sydney. So that's a great way to engage with companies that are coming through our network that we're trying to get involved in Australia.
Thank you, Ross. I think it would be great if you wouldn't mind popping in the chat the best way for folks to to get in contact and reach out on those events. I know we're running out of time. We have a couple of questions in the Q&A. What financing mechanisms are most needed to bridge the gap between university R&D and commercial investment in emerging SAF and green fuel technologies? Maybe this is one for you, Ollie or Rupert. Perhaps you, Ollie.
Well, look, in that stage, it's typically grants or using CRCs or other scenarios. If you're coming out of university and you haven't kind of got it much further than that, then it's really uninvestable for most participants. There are a very small number of venture capital funds who might look at it, but typically when you're coming out of R&D in universities, it tends to be incubators or government grants to start off with.
Thank you. There's another one on offtake. Are people concerned about the very limited number of offtakers for SAF in Australia? Not a lot of price competition relative to other LCLF products. How will the industry manage this? Tim, would you like to answer that one?
Yeah, sure. Happy to, Joy. And I think there's probably two things at play here. So fortunately, through our project, we've had that opportunity to do some market sounding extensively with not just the aviation industry, but other major users of renewable diesel. And fortunately, with most low carbon liquid fuels products, there is production facilities, there is that opportunity to switch between those two uses. I think the second thing to note here is there's currently a demand side consultation underway. One of the key questions for response is around that topic of obligated party. So I understand, Ross, the European experience, at least in the early stages, was placing the fuel suppliers as that key obligated party. And one of the lessons learned from the initial European experience is some airlines who did want to enter into long-term offtakes, they may have lacked the ability to apply those credits to a particular airport that they landed or they uplifted fuel from. So I think there is a live policy question around, is a fuel producer going to be the obligated party, or is there going to be a bit of an opt-in system for major users of low carbon liquid fuels? To the extent there is that opt-in arrangement, then you do extend the number of off-takers and you extend that, recognizing that there is a limited pool of domestic SAF customers for SAF absolutely here in Australia. There's quite a lot of international potential users as well. But then I think broadening the opportunities, I think the government is consulting on right now to not just SAF, but also renewable diesel, opens up great opportunity for more projects to be developed and financed here in Australia.
Thank you, Tim.
Sorry, Joy, can I just quickly add to that, on that renewable diesel point? So obviously low carbon liquid fuels, we're really talking about second generation and third generation low carbon liquid fuels here. We're talking about drop-in fuels.
Yes.
And it's both SAF and renewable diesel. And obviously there's a whole lot of users of diesel in Australia that really are challenged to electrify. And renewable diesel from these low carbon liquid fuels plants, actually the economics is actually better than going to SAF. You make a higher margin because your diesel price is higher than jet fuel price, and you're also on the crack side, you get benefits. So the market, I wouldn't just think of the market as Virgin and Qantas. I think the market's beyond that.
Thanks, Rupert. Thanks, Tim. Ross has just popped in the chat, which I think is mostly visible for hosts and panelists, but his email is ross.cooper@austrade.gov.au if you want to email him about the events coming up. We've got, do we have time for one more question, Fraser, or should we move to?
If it's a really quick one. It's a really quick one.
All right. What do you see the lead way between feedstock coming from single organization, i.e. GrainCorp, moving into feedstock from regional resource hubs? Tim, would you like to answer that one as well?
Given our partnership, I'm happy to. I think that the key for us, and one of the benefits Rupert mentioned around low carbon liquid fuels, is as a drop-in fuel. You don't have to replicate entire supply chains like you do for the hydrogen industry, and that's really important from a cost competitive perspective. I think to answer the question around feedstocks, there's an incredible logistical task of harnessing these millions of tons of feedstock in an efficient way to get it to refineries. So my question and sort of count response would be, what is the most efficient way of getting your particular feedstock to where you need it, and how can you do that efficiently?
Thank you, Tim. I think that wraps up our panel. Fraser, would you like to wrap up from there?
Thank you very much. That was great. Thank you, Joy, and thank you to all our speakers. I really enjoyed that. I thought there was so much content. And look, I'm not going to try to summarize all of that, but I thought, for me personally, some of the key things, it felt like there's sort of two categories, right? There's a bunch of things that are kind of outside the control directly of projects around that demand mechanism consultation and that the financing mechanisms. However, as Oliver rightly said, there is a chance to put your voice and put your voice strongly and directly through there, and Bioenergy Australia will be a channel, hopefully, for getting some of those views to government. And then the second is things that are inside the control. There was a bunch of things, but I was sort of struck by, don't neglect the offtake customer journey, and really been very clear on that and giving it due process. Really understanding your competitive edge, particularly versus some of those international projects, and whether you do have something that's a truly distinctive offering. And as Celine rightly mentioned, if you've done the work, make sure you're translating that into materials that speak to investors, and puts you in your best chance. So thank you to all of our speakers today. Really, I hope it was useful for all the participants. And with that, I'll hand over to Shahana.
Thank you. Thanks, Fraser. Well, yes, that brings today's webinar to an end. Thank you so much, everybody, for joining us and for the great questions and discussion. Massive thank you to the team at Cyan Ventures and all of the speakers and panelists that joined us today. It was fantastic. There'll be a short evaluation survey at the end of today's Zoom session. So if you can just take a couple of minutes to complete that, that would be fantastic. Please make sure you let us know what you want on our future webinars. We're doing them every 2 weeks at the moment. We've had up to 400 people attending them sometimes. So we would really love to continue this conversation and have people engaged in really driving this industry forward. So make sure you let us know any suggestions. And as indicated before, recording will be up on our YouTube channel, as all of our previous sessions are. So you can check it out and share it with colleagues and others that maybe weren't able to attend. Thank you, everyone. Have a wonderful rest of the week, and enjoy moving into spring. Can't wait.